Whether you like it or not, taxes are pretty much everyone's biggest expense that they'll have over the course of their life. During your working years, unless you're a business owner or a real estate professional, there's not a whole lot you can do to reduce your taxes. But one of the reasons I like working with retirees as a financial planner is that there's a ton of different opportunities to reduce both your current and future tax bill as you transition from your working years into your golden years. There's a laundry list of different ways that you can save money on taxes in retirement, but in this video, I'm going to focus on 3 of them in detail, as well as share some real life examples where I've implemented these strategies with clients to give you an idea of just how much money can be saved. Hey everyone, if we haven't met yet, my name is Jake Skellhorn. I'm a certified financial planner and co-founder of Spark Wealth Advisors, where we help people across the country retire with confidence and clarity. If you haven't already, consider subscribing to the channel. I typically post once or twice a week on retirement-related topics. If you enjoyed this video, let me know by liking it and sharing it with a friend. And as always, leave a comment below with any questions. So the first way, and perhaps the most impactful way that you can save money on taxes over your lifetime in retirement, is through Roth Conversions. If you're watching this video, you might be familiar with Roth Conversions by now, but if not, a Roth conversion is just converting money from a pre-tax account like a 401k or an IRA into a Roth IRA. The whole point of a Roth conversion is to pay taxes now instead of later, ideally at a lower rate than you'll pay in the future. Common opportunity for Roth conversions is for retirees who retire before they plan to take Social Security benefits. So let's say you retire at 62 but don't plan to take Social Security until 67 or 70. Well, those years before Social Security, you're likely going to have a low amount of taxable income, putting you in a low tax bracket. So by converting money to a Roth IRA in those lower tax brackets, you're never going to have to pay taxes on that money again. So you're locking in your taxes today and withdrawing that money in the future without having to ever worry about what tax rate you'll owe. A couple other reasons that you would do a Roth conversion would be to mitigate your RMDs later in life. So when you're age 73 or 75, you'll have to start taking money out of those pre-tax accounts as a required minimum distribution. Well, I've worked with a lot of people who later in life don't necessarily need that money for income. So when they're forced to take it out, it can increase their income drastically and cause them to owe more taxes on it than they need to pay. Other indirect effects of an increased income from RMDs would be IRMA surcharges, so Medicare surcharges because your income is above a certain level, and causing your Social Security benefits to be taxable because your provisional income is higher due to those RMDs. Let's take a look at an example of a couple of clients that I'm currently working with where I'm going to recommend Roth conversions, and it'll show you just exactly how much they're projected to save over their lifetime. All right, so here's our client couple. I'm not going to go into too much detail on their situation for the purposes of this video, but this is basically the tax allocation of their account. So they have about $335,000 in taxable assets. So this would be between brokerage accounts and money market accounts and savings. And then they have about $225,000 or so in tax deferred assets, which would be a 403B that they have, traditional IRA, again, pre-tax money. And then they don't currently have anything in Roth IRAs. So they're sitting with about $560,000 or so between these two accounts. And we're going to take a look to see how Roth conversions can impact their plan long-term, just how much they can save over the long run. So one other thing to note is that their current income is about $80,000. Only one of them is working at the moment. So they are in one of those lower tax brackets. They're in that 12% tax bracket with their income. So again, prime candidates for Roth conversions. So let's take a look. All right, so in this distribution module in our planning software here, we have a graph. So just to explain a bit about this. So each of these lines is going to be the income tax brackets. So as you can see, each bracket has 2 different rates. This is because the Tax Cuts and Jobs Act is ending at the end of 2025. So by default, tax rates will go up slightly. Obviously, we don't know exactly what the future holds for tax legislation, but by default, taxes will automatically increase in the future. So that's why you see these lines changing. The dark blue line is their current income. So after deductions, their income is about $54,000. So by implementing Roth conversions, we can take a look to see just how much they can save in taxes in the long run based on what their withdrawal needs are later in retirement. Now, so if we suggest filling up the 12% tax bracket, which is going to be this dark green line here, in fact, we can just eliminate the other ones just for simplicity. If we suggest filling up the 12% tax bracket with their Roth conversions, let's take a look to see the impact over the long run. So over the long run, they would save over $300,000 by converting that pre-tax money to Roth, again, each year without going over that 12% tax bracket, because later on when they withdraw it, they're not going to be paying any taxes on that money, and all that money inside of the account is going to be growing tax-free. And another thing to note is that this is the result of a Monte Carlo simulation. So 1,000 different projections based on various market returns that could happen over the next 30, 40 years or so. This is the median outcome. So in other words, it's not the most optimistic outcome. It's not the most pessimistic. It's right in the middle of those 1,000 outcomes. So it's pretty reasonable to rely on something like this for future outcomes. And just to play with the other numbers a bit here, if they were to fill up the 22% tax bracket with Roth conversions, they're actually going to end up with just a little bit less, because they're not going to be needing a whole lot in retirement. I think their budget was around $3,500 a month. So by converting more of that now, when they withdraw it, they wouldn't have paid that high of taxes on that money anyway. So it would work out better in their situation to stay in the 12% tax bracket. But we can see which scenarios make sense on a case-by-case basis by selecting different tax brackets. So as you can see, 12% tax bracket is going to benefit them the most. And this number is coming from an estimated terminal tax rate of 15%. In other words, at the end of their lives, if they have money left over, they're assuming that their beneficiary is going to withdraw that money at 15%. In the case of the Roth IRA, obviously they're not paying that. So it's comparing the Roth withdrawals at 0% to withdrawing this money from a traditional account at 15%. The second way that you can reduce your tax bill in retirement is through tax gain harvesting. You may have heard of tax loss harvesting, which, if you haven't, is purposely selling investments at a loss so that you can deduct those losses against other taxable gains or other income, thus reducing your tax bill. But tax gain harvesting is essentially realizing gains in your taxable brokerage accounts to stay within the 0% capital gains tax bracket. In other words, paying no taxes now so you don't have to pay taxes later. So similar to Roth conversions, capital gains harvesting is essentially locking in a tax rate today, which in this case is 0, so that you don't have to pay taxes on that money ever again. With both tax loss and tax gain harvesting, the primary goal is to keep your money invested, but take advantage of tax benefits that can only be utilized in the current year. So in either case, you essentially want to sell your investments and then repurchase them as soon as possible. With tax loss harvesting, to avoid a wash sale, you have to wait at least 30 days before or after the sale date to purchase that investment. You can purchase something similar. So for example, if you sold a total stock market index fund at a loss, you might buy a S&P 500 fund, which is only US stocks, and you should be able to get away without getting a wash sale. But the purpose of reinvesting your money is to make sure you don't miss out on any market gains. Now, with tax gain harvesting, you can repurchase the same exact investment right away because there's no loss to begin with. So for example, let's say you own the ETF SPY, which tracks the S&P 500. If you sell that fund at a gain, you can repurchase it immediately at a higher cost basis, and you won't incur any sort of wash sale. If you're married filing jointly in 2024, you can have up to $94,000 in adjusted gross income and pay $0 on any capital gains. If you add in the standard deduction, which is about $29,000 in addition to that, you can really earn upwards of $123,000 or so in adjusted gross income and pay $0 in capital gains. Just remember that adjusted gross income does include capital gains. So once again, tax gain harvesting is purposely selling investments at a gain, pay 0% in capital gains tax now, and increase your cost basis on those same investments so that you never have to pay taxes on that gain again. So let's look at an example of tax gain harvesting. Let's say that you're married filing jointly. You and your spouse have a taxable brokerage account with $250,000 invested in it. $200,000 of that is considered your cost basis, or what you paid for those investments, and the $50,000 is considered a long-term capital gain. Let's say you have $60,000 of other income from pensions or Social Security that is considered taxable. Even if you don't need any additional money to live off of, you can still sell all of those investments in your taxable brokerage account, realize that $50,000 long-term capital gain. That would make your adjusted gross income about $110,000, meaning you wouldn't have to pay any capital gains taxes on that gain. The second step would be to just turn around and repurchase your same investments for what they're worth today, which is again $250,000. But now your cost basis is $250,000, meaning that's money you've already paid taxes on and will never have to pay taxes on again. Tax gain harvesting can be really useful if you have a concentrated position, say in an individual stock that you held through your employer. If you don't want to sell all of that concentrated position right away, you can strategically sell enough of it each year to stay within that 0% tax bracket and use the proceeds to invest in more diversified investments. Tax gain harvesting can also be useful to know about if you are just doing a regular rebalance of your portfolio. Let's say you're towards the end of the year and you want to shift some money from stocks into bonds. It's useful to know how much of those investments you can sell before you have to start paying taxes on them. The third way that you can reduce your taxes in retirement is through qualified charitable distributions, or QCDs for short. So when you turn 70 and a half, retirees are able to make distributions directly from a traditional IRA to a charity without paying any taxes on that money, since it's not received by you first. Of course, a QCD really only makes sense from a tax perspective if philanthropy is already part of your plan. If you already plan to give to charity in some way or another, then a QCD is going to be the most tax efficient way to do so. But if it wasn't already part of your plan, it doesn't make sense to give away, say, $10,000 to save $2,000 in taxes. But with that said, I've worked with a lot of people throughout my career who surprisingly don't need the money that they receive from their IRAs as a required minimum distribution. So if you get to that age and you don't really need that money that you're required to take out, it may make sense to donate it as a qualified charitable distribution if it's, again, part of your plan anyway. Since RMDs are based off of your account balance, QCDs can also reduce your RMDs in general. So let's take a look at an example of how a QCD can reduce your tax bill. We're going to look at two scenarios, and this is an example I found on Charles Schwab's website. I'll include the link in the description below if you want to take a look. So a couple assumptions with both of these scenarios really quick. We're going to assume that you are age 75. You have a substantial balance in a traditional IRA, which is causing a large RMD that you don't necessarily need all of. And the other assumption is that you've decided that you want to donate $35,000 to charity this year as part of your regular financial plan. So in scenario one, there's no QCD. So you have other portfolio income of $50,000. This would be from like a pension, Social Security, things like that. You have your RMD, which is $110,000. So that brings your total pre-tax income to $160,000. After you've received the RMD, you take that $35,000 of that and you donate it to charity. So since you're donating it, it is deductible if you itemize your tax deductions. So you get to deduct $35,000. You're left with $125,000 of taxable income and taxes due of $23,400. And then just a couple disclaimers down here. The tax calculations are using the 2023 tax brackets. They also assume that 85% of your Social Security benefit is taxable. And the standard deduction is $15,700 for a single individual in 2023. All these numbers have been updated for 2024. But again, this was an example that I found on Schwab's website. So in scenario one, where you take the RMD yourself and then donate the cash, you owe a total amount of $23,400 in taxes. So in scenario two here, instead of taking the full RMD and receiving it to yourself and then donating the $35,000 to charity, you're going to do $35,000 of your RMD amount directly to charity as a QCD. So you still have that non-portfolio income of $50,000. That has to come out of your IRA is still $110,000. But you get to subtract $35,000 of that from your taxable income since you're not receiving that. So instead of $160,000, your pre-tax income is now $125,000. You don't get to deduct the $35,000 as an itemized deduction because the money came straight from your IRA and not from yourself. So you're going to use a standard deduction of $15,700, but that still leaves you with taxable income of $109,000, which brings your taxes due to $19,632 instead of $23,400. So just to recap, probably the most impactful way that you can save money on taxes in retirement is through strategic Roth conversions. By converting money from pre-tax to Roth when your income is low, perhaps in those years before you claim Social Security, you can save literally hundreds of thousands of dollars over the course of your life. Also, don't forget about tax gain harvesting. Take advantage of that 0% tax bracket for long-term capital gains where you can. Any unused amount in that tax bracket does not roll over, so make sure that you take advantage of it every year that you're eligible. And lastly, if you are charitably inclined, consider qualified charitable distributions from your traditional IRAs when you turn age 70 and a half, and make sure that you're sending that money as a QCD directly from your IRA, not withdrawing it to yourself first and then donating it, which is going to have less of a tax benefit. So, hope that was helpful. If you can think of any other ways that you can save money on taxes in retirement or any other ideas you'd like me to share in another video, be sure to leave a comment below. Thanks for joining, and we'll see you in the next one.